It was a very interesting and rather polarizing week when it comes to the data in the real estate landscape here. First off, we saw Canadians hit a new all-time high in their household net worth. On the other side, though, we saw mortgage originations basically hit a record low. Meanwhile, inventory is spiking, inflation rose, but somehow house affordability improved, while debt insolvencies are also rising. It's enough to make your head spin. Well, we're here today to shed some light on what's really important and how all these elements are going to affect the real estate market over the summer months. First off, my name is Dan, and I'm here with my business partner, Ryan Dash. We are the Vancouver Life Real Estate Group, and every week we bring you your dose of what is important in the Vancouver real estate market. Let's get right into it. Off the top, I think we should touch on the inflation print that just happened this last week. It was expected lower in May down to hit 2.6, but it surprised to the upside, hitting 2.9%, up from 2.7% in April. The markets reacted right away, basically trimming any chance of a rate cut at the July announcement from 70% down to about a 45% chance of a cut happening next month. While the markets may absolutely be correct, let's consider the elements that pushed inflation higher last month. And of course, how the Bank of Canada might be looking at them as well. Because the shelter cost index remains the major driver of inflation with these, of course, higher rates. We saw it push to 6.4%. Whereas last time at the same month, it was 4.7%. So obviously, this is a huge part of the CPI basket right now. Mortgage interest costs alone were up 23% compared to this time last year, and rent 9% from the same time last year. This is a truly frustrating amount, considering that the normal amount for rental rate inflation is around 1.5%. How do you possibly enjoy your life or even save for a home when your rent payment is taking up the majority of your income? Now let's look at it, the CPI basket, excluding shelter, just so we have a reference here. And excluding shelter, the CPI, the Consumer Price Index, rose about 1.5%. So clearly, it's high interest rates that are continuing to cause high inflation. When we look at it through that lens, well, the Bank of Canada could still be on deck for a cut in July. Maybe. But looking to the end of 2024, what are the markets pricing in for rate cuts? Only two, ending the year at about 4.25% overnight interest rate. But here is something to really make note of when it comes to predicting the future of rate cuts. StatsCan, who is responsible for tracking and reporting inflation, well, they've just decided to update their CPI basket weights. As in how much weight does each component have when it comes to the overall basket in inflation, right? They can decide that, hey, interest on mortgages is more important than, let's say, groceries, right? And they can kind of massage these numbers up and down. But what they've done, and listen to this, mortgage interest cost has seen a relatively massive increase, rising from 3.5 to 5.2% of the overall basket weight. Okay, it's a 50% increase. Now that the Bank of Canada is cutting rates, having the mortgage interest rate component of the CPI basket constitute a larger share of CPI means that reported inflation has the potential to fall at a much faster rate. So StatsCan has essentially just engineered a much weaker inflation reading later this year and likely through 2025. Because, of course, as inflation drops, it has more weight within the basket, kind of superficially inflating the dramatic drop that it's about to have, meaning it's going to push inflation down quicker because they decided to give that more, quote unquote, and pun intended, weight. This, of course, gives the Bank of Canada more confidence that inflation will continue to trend lower, right? If they cut rates and interest payments, which now have more weight in the CPI basket, continue to drop, well, hey, it's a self-fulfilling prophecy on the way down. And of course, that would give them the ability to cut rates further as this happens because they're getting that inflation rate down to the target 2%. Now, for all the people in our comments who thought interest rates were going to 10% or higher or whatever it was, this is a perfect example that the game is rigged, and the government can simply move the goalposts as they see fit. They can manipulate the inflation reading, and you're going to see that happen moving forward now that the basket weights have been shifted. Does that sound fair? Is it right? Is it wrong? I'll leave that up to you to decide. But either way, that is the reality. So looking forward, should those interest rate cuts happen, would they stimulate the Vancouver real estate market enough to maintain current prices? Or are they going to continue going up? Or are they going to start going down? That depends, of course, on a number of factors. So let's examine the landscape a little bit further, starting with the current and ever interesting population growth.
Dan, that's fascinating. Unfortunately, it's also not surprising. I have so much to say about that, but maybe we'll leave that for another podcast. If we start touching on population, Canada's population grew by another whopping 243,000 last quarter, hitting 1.27 million annually. This is a new record. This was also just ahead of the previous quarter, though, and likely indicates that we are near the peak of this level's annual growth. And it likely, the quarter that was led by non-PRs, it added 132,000 people. And the total amount of non-PRs in the country is sitting at 2.8 million people, nearly 7% of our population. This has more than doubled in the last 4 years, and it represents 66% of Canada's population growth over the past year. And while we're likely at the peak of the growth rate, the government's promise to reduce the amount of non-PRs to 5% of the total population within the next 3 years is not a promise that can easily be kept. A reduction of roughly 59,000 non-PRs per quarter for the next 3 years, would be required. This doesn't necessarily mean deportation or anything like that. I mean, there's a really good chance that a lot of these numbers will become permanent residents. Though one element that will organically reduce the population growth is the amount of available jobs. And if we go back to the peak of the pandemic, I think we were talking about job vacancies numbering near 1 million or about 1 million. It was huge. Well, that number has now dropped dramatically. In fact, in the last 2 months alone, it's down 13%. We are now back to pre-pandemic levels of 550,000 job vacancies. That's almost half of where we were at the peak. And people won't move to a place where there isn't any work for them.
Yep, very true. Why would you go somewhere where if there was no jobs, no income, and no promise of a brighter future? Well, what else is happening in the future? Let's shift to another very important element within real estate, and that's building permits, right? Building permits give us great insight into future inventory numbers. We know, hey, I'm applying for 100 units. It's going to take me 3 years to build. You can put that one on the map for expected inventory at that time. Last week, we found out the building permit numbers actually blew out expectations, rising 20% month over month in the month of April. In unit terms, permits were up 81% year over year. But wait, how can that be, Dan? You've been telling us for months that the landscape for developers is awful. What on earth would cause such a spike in building permits? And have I just been totally out to lunch with my predictions? Well, let's have a look. Firstly, a couple things to note. The majority of those building permits are for rental units, or almost certainly, because the data doesn't actually parse out rentals versus end users. So it's an educated guess. But we can dig a little deeper there because rental starts have surged about 40% compared to all starts. Only a decade ago, that number was 10%. So a huge number of rentals. And purpose-built rentals, for example, have surged from 20,000 to 140,000 in that same timeframe, driven largely by the access, of course, to cheap financing. Right? CMHC has what they call an MLI Select program. And what that does is it incentivizes builders by offering them very low premiums, a 95% loan to cost financing. So you can obviously finance the majority of your building, and 50-year amortizations, which further lowers the monthly payment, right? So if a builder is looking at two options and they're like, well, great, we can borrow money dirt cheap over here thanks to CMHC, as long as we build rentals, well, let's do that because there's more money in it for us. That's, the capitalist world we live in. That program has proven to be wildly successful, and why we see basically an all-time high right now in rental units under construction. So what did the government decide to do? Well, they decided to change the goalposts, move the goalposts to essentially make this program unviable, especially in cities like Toronto and Vancouver. Typically, a builder has to get what they call favorable terms, right? They have to check a lot of the boxes, and a developer would need to enter into a 10-year affordable rental guarantee for 1/3 of its units, right? A rental rate of 30% of median household income is what is considered affordable there. That now makes most projects in cities like Vancouver and Toronto essentially unviable, right? They can't profit when they can't have their units making income, right? So what's largely happened here, what we think caused the spike, is that developers were getting ahead of this change, ahead of the goalpost move that the government has made, because it comes into effect on June 18th. So it's in effect now, but developers have known it for a few months here. So they would have put forth their applications, their building permits in the month of April to get the old terms so they can actually be profitable before the June 18th deadline, which is now passed. So you are going to likely see, somewhat in the month of June and definitely in the month of July, building permits for purpose-built rentals drop off dramatically. Okay, so keep in mind too, it's also coming at a time when dwellings under construction have peaked at about 350,000 total and have been trending downwards for a few months now. So there's less homes under construction now. We've got the goalpost moved on rentals, so you're going to see way less of those in Vancouver and Toronto. And as we know, building permits for single-family homes are at an all-time low.
Part of me feels like, I don't know if it's a comedy of errors or if it feels like a masterfully orchestrated plan and we're getting pieces of it. I can't seem to make out which one it is. I guess we'll see over time here, but let's have a look at mortgage updates. So 4.99% mortgages are back, and they're back at least for now. A number of the 6 big banks are now offering mortgages at rates below the psychological 5% range. Seeing a 4 in front of a mortgage rate is the trigger for some people to get off the sidelines. It's beforehand, anything with a 5 or even a 6 in it, it was just a non-starter for people. Seeing that 4 is likely a trend in the right direction and getting more people off the sidelines. In fact, we're already seeing an increase in mortgage originations, which ticked up in April by 29% year over year, with mortgage volumes hitting a 3-year high. And what is the most popular mortgage right now? Well, it's a 3 to 4 year fixed, followed quite closely in second place by those fixed rates that are less than 3 years. Variable rates are currently the least popular, though I expect to see that change as we continue to get more rate cuts. And looking forward, the Canada Mortgage Rate Forecast shows the variable rate hitting 4.35% by the end of 2025 and fixed rates at 4.9% by that time. That is the year, though, many will be renewing from where they are, and it'll be 1 to 2 times what they're currently paying. So expect some more payment shock to be coming over the next 2 years for those mortgage holders.
It could likely be considered, a good sign for the landscape that mortgage originations are increasing. Like Ryan mentioned, up 29% year over year, which is a significant number. Let's be honest and be fair, though. That's basically coming off of record lows. So the baseline was low, but it is certainly trending back up. I'm certain we're well under long-term averages, but it's interesting to see it trending up when, of course, we've only just seen the first rate cut, and that data will be before the rate cut. So perhaps there will be a further slight upward trend in new mortgages based on people's optimism looking forward. Now let's talk a bit more about inventory and what is happening nationally here, because inventory is always interesting and really does move the marketplace. It's certainly continuing its upward trend in most of Canada, most notably Ontario, where active listings are up 70% from this time last year. That has helped push the national total up to what is considered quote unquote normal, as in we're back to long-term averages here. Active inventory nationally is sitting at about 170,000 homes. That is up from the 2022 low, where it hit as low as 90,000 for a while there. That was a tight market. Though we are still below that peak that we saw back in 2015, a mere 9 years ago, when there was 250,000 homes to choose from. Locally here in the greater Vancouver area, we are seeing inventory increase for the 6th straight month in a row. We're currently, like if you take a snapshot today, being Thursday, January the 27th, there are 14,800 homes to choose from here. And that's a 5-year high. But here's where it kind of gets interesting. Should we get a mere 900 more listings and crack 15,700, Vancouver, Greater Vancouver, would actually be at a 10-year high in active inventory. And that will very likely happen next month, the way things are trending. So what's bringing all this product to market when we've been so tight for the last 3 years? I think certainly part of it is going to be these people that are offloading those investment condos that they either A, can't Airbnb anymore, or B, they're so cash negative because they're on variable rate mortgages that they're losing so much every month, they're offloading those. We are absolutely seeing that in Toronto. A lot of people can't afford those summer homes that they picked up, that beautiful cabin on the coast that they bought in 2021. Well, those are being offloaded as well. Sunshine Coast inventory is increasing too. I find it quite fascinating to see that essentially all home types in almost all areas are increasing. It's not just condos downtown. It's not just condos beach homes along the coast. It's not just homes in Whistler. It's kind of happening everywhere. So we're starting to see people offload these properties that they maybe cannot afford, and definitely those secondary and investment properties. A few more months of this inventory hike and, very good chance we'll start to see some downward pressure on prices. Already happening in places like Toronto, but in Vancouver, we're just not seeing it yet. It's still that push and pull battle. This month of June will basically, I think it's going to end up price-wise flat. We may see an uptick in the HPI as it's still catching up to the median average that we've seen increase over the last few months. But sellers still seem optimistic with their pricing. And what I mean by that, so far this month in June, the average sale price is $1.346 million. But if you compare that to the average list price, what people want, it's almost 200, or it's over 200K higher at $1.57 million. And then same is happening with median, right? Median sale is 980K, but the median ask price is 1.14 million. So you've got these people that are still coming to market thinking they're going to get a number above what is quote unquote actually happening in the normal sale price. Why did they think that? Well, guess what? Their net worth may be a reason for this optimism.
Let's kind of get into that. This is a very interesting topic here, especially considering the landscape we find ourselves in. I've got a few kind of personal thoughts as to why this may be the case, but let me download this information first and let it resonate with you. So Canadian household net worth hit a new all-time high in Q1 after increasing 3.3% on the quarter. Canadians are sitting on $17 trillion worth of assets. Keep in mind, 45% of that wealth, nearly half of it, is in real estate. And this is somewhat a vulnerable asset at the moment, especially when you look at a place like Toronto. Those condo investments have dropped dramatically in price. And though even after the 14% national decline in home prices since the 2022 peak, Canadians are still wealthier than they were prior to that. Adding to this, the household debt service ratio actually ticked down last quarter. But at the same time, though, household interest payments jumped to an annualized $170 billion in Q1. Oof, that's a big number, especially when you consider the fact that that number was $90 billion just 2 years ago. It's almost doubled. That is a lot of foregone discretionary spending. So it's definitely not all rainbows and butterflies. On the top of the large decrease in discretionary spending, household debt to GDP still paints a really bleak picture. Globally, Canada has the third highest debt to GDP ratio, only behind Switzerland and Australia. It's actually at 104% of our debt to GDP. So with higher interest rates this will affect Canada's economy harder than those with lower debt ratios. And I kind of just want to speak just a little bit more to this in one instance here, because so much of this has to do with the amount of money that's in our system right now. The amount of quantitative easing has ballooned. In fact, I was mentioning to Dan offline here, I actually went through part of the 2024 Canadian budget. And if you actually go down to how they're going to service their debt, out of our $508 billion budget, 83% of that, 83% of our $508 billion budget, $420 billion is going to servicing debt, rolling over that debt that's been accumulated over the last decade. That's an incredible number. And I bet you my 5-year-old can do math and tell you that that's not a responsible way to run the country. And so while interest rates, I think, are really important, I also think global liquidity is going to become a huge issue in the coming years.
It really speaks, all this information that we're sharing, to what I consider an ever-widening economic gap here. The wealthier are wealthier, the poorer are poorer, and the middle class are struggling more than ever. And that segment of the landscape seems to be shrinking here. And it's represented, I think, in the national budget because it's being mismanaged equally as bad here. And when we look to, let's say, people that are feeling wealthy, well, I just want to make a note here that just this week, we saw the highest sale price to ever take place in Greater Vancouver as far as a public sale on the MLS goes. The previous record was set last year up in Whistler at $32 million for a single family home. And this week, the Point Grey area took that crown and leapfrogged it by a significant amount with a home selling for $44 million. There's somebody who's feeling wealthy right now. And just goes to show, well, so many are struggling. Some people are buying, $44 million homes. And it does speak to exactly what we discussed.
Dan, it's like I said in a podcast either last week or the week after, or a week before that usually during difficult economic times, money moves from weak hands to strong hands. And that is a prime example of what I was talking about. It's not a policy or something I agree with, but it's what happens.
That's it. Okay, let's talk now about development. Okay, we've still got a provincial and a municipal government and also a federal government who's saying, let's build some homes. Okay, so we've got in BC, starting in just a few days here, the small scale multi-unit home initiative, aka the multiplex plan, comes into effect on July 1st. July 2nd is the day after the holiday here. And the information, the data, the municipalities that are kind of adopting it and how they're adopting it continues to unfold here. As we've reported on recently, the province is trying to provide this density and therefore provide more housing in an attempt to ultimately make things more affordable. On the forefront of almost every news story and almost every political campaign right now is affordable housing. But yet, we'll see things like a provincial legislation pushed down only to have the municipality see that legislation as ultimately a cash grab and just increase their development fees. You've likely heard, or we touched on just last week, how the city of Burnaby was going to adopt this, but say, for every unit that you want to build, well, there's an additional $50,000 in fees to build, completely eroding that same affordability. This week, it's Vancouver's turn. So in the TOAs, right, in the transit-oriented areas, they are allowing a lot more density within 800 meters of, let's say, a SkyTrain station. If you're within 200 meters, you get to build 20 stories. If you're within 400 meters, it's 12. And then if you are further out, 800 meters, you can build, I believe it's 8. So they're trying to build as much housing as possible. But the bylaws that are coming through are now saying, look, you're allowed 5.0 FSR within 200 meters of a SkyTrain. Okay, that's big. So if you have 1,000 square foot footprint, you can build 5,000 square feet of properties there. So it's big. And the city said, look, well, we're going to give you the option to increase that even more. You can build even more homes. They're going to add 10% to that density, giving you a 5.5 FSR. Great. Oh, but wait, there's a catch. In order to get that increased density, you either have to go 100% rental with 20% of those homes being below market, or get this, if you go strata, meaning you can actually sell these, then the city is asking for a mere 30% of the units to be gifted back to the city. So after going through 3-4 years of permits and paying all the city fees and finally building this thing, they're now taking 30% of your potential revenue. Obviously, that makes it unviable. Obviously, I don't think any developer is going to choose that option because the margins are already so tight. How on earth do you go out there and say 30% of your final product can just be cut out and given to the city? Wasn't noted what they do with this. I don't know if they're moving in their employees, if they're selling them themselves to help fund their deficits. I didn't catch that part, but either way, you get the idea, right? One hand gives and the other one takes. It just is another example of how every time somebody wants to make more housing in the city or the province or the federal government makes it even harder.
If you don't agree with the policy, if you don't agree with density, let's say you're the guy who bought a $44 million house in Point Grey and you don't want that in your neighborhood, what's the best way to get people on board with the program or agree with the province, but not actually have to do anything? And this is how you stifle. This is how you slow the whole process down. Instead of solving the problem, create a new one. And that's exactly what I'm smelling here. This is just a runaround to benefit probably a portion of the economy that doesn't like this idea when we so desperately need it in these areas that have the land. Anyhow.
Mm-hmm. Yeah. Yeah. It's like, here's $100 to go and buy groceries. Awesome. But, but me and my friends are coming over for dinner. We're going to eat 30% of what you've made. It's
or invite yourself over.
Now, I think part of what we're seeing here too, when it comes to what can you truly expect with further and future inventory here in the city of Vancouver for new product. Do you remember back in October when we reported on there was 3 developers who had asked for extensions on their rezoning deadline? And the reason was when you get a piece of land rezoned, you've got a window of time before you actually have to start construction. And as the interest rates rose, the numbers didn't pencil, right? They could not make the building that they had planned to make 3 years earlier work anymore. So they're like, well, look, can we at least get an extension so that if and when times get better and we can afford this and we can finally bring product to market and not lose money, we'll do it. Well, they've just asked for a second extension. Right? Interest rates are still high. City fees are increasing. The numbers still don't work. So I don't know the outcome yet of that extension request, but you get the idea of how incredibly challenging this landscape is. And when the city continues to keep grabbing their pound of flesh and then making it 2 pounds of flesh, well, at what point does this thing just seize and implode on itself?
Well, I don't even think builders can make 30% on their buildings unless they land banked over 10 years ago. They're not making 30% in today's environment. And so that's
no, absolutely not.
So the whole idea is to push a policy without having to push it, I guess.
Yeah. Now, I'm going to shift just a hair because I know this sounds all very negative, but the multiplex plan does work in some areas. And I've got a number of builders that Ryan and myself know that have identified some great areas that they definitely want to build in and can offer a premium for the right lots in the right areas. So if you or someone you know actually has a lot in Burnaby that is on a corner or has a laneway or both and has at least 66 feet of frontage, please give us a call because we can likely get you a premium price on your lot. So that's Burnaby, 66 feet or more of frontage with a laneway or on a corner. If that is something that you own or know somebody with one, get in touch with us and we'll kind of demonstrate what kind of land sale we can get you because it's likely higher than an end user. So that's it for this week. It is, again, forever interesting. There's a lot of positive, there's a lot of negative, and depending which side of the fence you're on, it's still a bit of a head shake. But here we are. It's almost the end of June. So next week's episode, we are excited to bring you the stats. What happened with sales and volumes and prices and, of course, inventory in the month of June. And quick heads up, low sales, high listings, stable prices. But hey, it's definitely setting ourselves up for that interesting summer, especially if we hit a 10-year high in inventory. We can all but guarantee prices will start coming down. It's just a mathematical certainty. Thank you, as always, for tuning in and watching. We will see you here next week.